Hi everyone and welcome. Oh, this is on, this is good. Thanks for taking the time at the end of what is a very exhausting week for everyone. Hopefully we've saved the best to last, and we've got some amazing panelists here today, and hopefully the conversation is going to be very informative. We've got a very tightly curated set of people here, so I'm sure it will be valuable for everyone. I'm going to take a little bit of time up top to share our perspective. So at Sylvera, we're very lucky to sit at the intersection of the buyers, the sellers, policy, supply, demand, price, and we don't get often the chance to share that perspective, so we thought we'd take the chance today to do that. What we're seeing in the market, emerging trends, our outlook going forwards, how we're responding to that, and hopefully it'll be of benefit. Why do we need carbon markets at all? Well, we need to do something about the climate, right? So emissions reduction of 80–90%, somewhere between 5 to 20 gigatons a year of removals by 2050, depending on your scenario of CO2. And sometimes we find people struggle to put this in context, so just up top, gonna lay it out. You see an analogy and something you'd all recognize, crude oil. To get from the beginning of the mechanized oil industry to half a gigaton a year of crude production took best part of a century, took 9 decades. And then our kind of core plan for managing climate change, just on the removal side, not on the emissions reduction side, which is actually the bigger lift, arguably, requires scaling up to about 6 gigatons a year by 2050, so 2.5 decades, right? So the scaling rate is literally off the chart, and that's an enormous challenge. And if you prefer distances instead of speeds, you've got about 150 billion tons of crude oil extraction to date in history. And for 1.5 degree trajectory, we need to remove about 1 trillion tons of CO2 by 2100. Even for a 2 degree track, you're looking at about 300 billion tons, so twice the historic extraction of crude oil globally. So these are very, very, very significant challenges. You can't even, it's impossible to understate them. So the market for carbon has been in a state of flux, a state of turbulence. We've seen lots of progress, and we'll share that, but some reflections on this. We still need to finance this activity, right? That challenge is immutable. It doesn't go away. It's tens or hundreds of trillions, probably like somewhere in that range, that we're going to need to finance in relatively short order. Carbon as an asset class is, and this is probably this is an obvious statement, but it kind of is often glossed over. It's very nascent. We don't have the market infrastructure that you would have in more mature markets. It's just emerging. Just the way that these instruments are described from a data perspective is not fit for scale. And from a legal perspective also, they're immature, right? So that's a blocker that we need to be cognizant of. And hopefully it goes without saying, nobody spends $100 trillion voluntarily, right? It's literally impossible. We were discussing this throughout the week. You cannot spend $100 trillion from a private sector perspective. You will be removed from leadership of whatever entity you're controlling, because you will write down the value of that business, right? So it's impossible to do that voluntarily. You need some incentive, or to be forced by regulation, right? So this is kind of where we are. And Charlie Munger famously said, show me the incentives and I'll show you the outcome. So right now our outcome is we have not invested sufficiently in emissions reduction, we have not invested sufficiently in carbon removal, and therefore we are off track. So our mission, this is actually our internal mission statement, to incentivize investment in climate action. So this is how we think about things, like how are the balance of incentives playing out? Where can we, as an actor, help to rebalance those? And that might involve our products. It might involve how we share data with governments, or trying to be a good actor, trying to redress this balance. So where are we? So from a private perspective, and actually a government one, everybody has a target, or broadly everybody has a target. The vast majority of entities have some intent to get towards net zero. This is 2023 data from Net Zero Tracker, so things have actually moved on positively since that. So great, you need a target. But this is our own survey data from end of last year. Nobody has a plan, right? So everyone has a target, nobody has a plan. The very, very small minority of entities know how they're going to deliver the net part of net zero, which is immutable. Everyone has to have the net part of net zero. Nobody knows how they're going to do it. So that's kind of the status quo. And coming back to the incentives, if you think from that perspective, the last 2 years in the voluntary market is completely understandable, right? So the reputational risk has spiked, obviously. Then how do you justify spending that money? Well, very difficult. You know, what you're doing is buying a risk without much benefit. And the prices have been depressed. There's no sense that there's no urgency around supply and demand tightening, or there hasn't been. And the benefits to action are limited. So in some cases, if you're an advisor, if you're involved in the market, you can use your action to your own benefit. But it's a tricky balance when you're dealing with the reputational risk. Arguably, if you act soon, you can lock in supply, you can lock in prices more cheaply. But if you didn't need to buy the credits anyway, because it was voluntary, then, well, that's a stretch, right? So what we've seen, which is basically a depression in price over the last couple of years, is like entirely understandable, right, in that context. So, so far, so gloomy. But the dynamics are changing. So we see this very clearly. Voluntary markets are formalizing. You're seeing some of the legal and regulatory guardrails being set in place, whether that be from industry action, like with ICVCM, or cross multi-stakeholder groups like ICVCM, VCMI, but also governments, national bodies, regional ones, and financial markets regulators. So the pace of regulation is increased, and this is exactly what you would hope to see, given some of the earlier statements, right? Some of those gaps are being filled in, so you're starting to approach a point of sufficiency, right? Also, this formalizing is creating overlap between voluntary instruments and more regulated. I mean, you already had this in California. You already have it in some limited cases, but you're seeing those points of convergence multiply and become more material, right? Actors like ratings agencies, but also ICVCM and others, effectively have shown that a significant portion of the supply is not really appropriate to make a claim with, and is very unlikely to be usable in a regulated context. So what that's effectively done is tighten a lot of the supply in the market by rendering it ineligible for many use cases. So ICVCM ruling the renewables credits out of CCPs is a good example. But this is across the board. We do a lot of work with off-takers, investors, assessing projects in their earlier stages of development. And there has been significant sustained investment over time in carbon projects, but they take a long time to come to market. So we're working on one at the moment. It's a very large ARR project, exciting project, no material output from that project till 2030. So it's a huge investment. It would appear in some of the stats you'll see, but it's not really going to hit the market for in any given material volume till 2030. And you do see challenges in actually getting the potential projects into development through lack of finance, through licensing, through legal challenges, through many different factors. So supply is tighter than you would hope. You're seeing the professionalization of investment into carbon projects on the abatement side and on the removal side. We're working, and I think I saw Charles here, we're working to support carbon growth partners by assuring a fund vehicle, not just for quality, but also the delivery of the credits. The professionalization of financing projects, and especially the use of debt in capital structures, you need to be very confident that the cash flows are actually going to come through, and we're able to help by assuring that the way the project's going to be operated is actually going to yield the volume of credits that are expected, and that can facilitate more capital coming in. But it's a different way of thinking about projects. It's a different way of financing projects. It's a more scalable way. So this is a promising sign. Until now, data has been a nightmare, frankly, in carbon markets. It's taken a lot of our time at Sylvera. Apologies if you've heard me say this week, but I heard it in my team and it was funny. But one of our data engineers said that the state of data in carbon was medieval. And then another one quit back. At least in medieval times, people spoke Latin and they could understand each other, like internationally. You know, if you could write, you'd know Latin. There is no such thing in carbon markets, right? You look at these, the documentation around the projects, and they're all basically it looks like a master's thesis. You can't parse it with machine in the way that you would do with any normal asset class. So the lack of data standardization doesn't help with the lack of fungibility. The specifications for some utility, for some actual job for the credit have not been very formal or been absent completely. And without some of these data challenges being solved, there is going to be an enormous, painful experience reconciling voluntary compliance and Article 6 instruments. It's going to be a nightmare. And we know because we work on ITMOs and Article 6 as well, and you can already see challenges in reconciliation. Thankfully, you see many initiatives that are trying to address this. So it's been somewhat piecemeal, but you're seeing greater standardization. The World Bank and the CAD Trust, UNFCCC, the Meta Registry, the S&P building, the ratings agencies are tidying up data. You're seeing software-defined methodologies, like from Isometric. The next step here really is to have interoperability of these emerging standards. And actually, many of these folk are at a workshop we're holding tomorrow, which is exactly on this. How do we get these to talk to each other from a data specification perspective? Once you solve those challenges, you start to facilitate the testing. Like, can I use this thing for this? Can I take this portfolio and use it against this set of regulatory requirements? You shouldn't need to pay Deloitte to figure that out. You should click a button, right? So that's not possible now, but it should be. So you start to see a change, right? So the friction to act goes down. The policy environment's becoming clearer. The reputational risk starts to get mitigated by actors like us and others assessing quality. You're seeing the benefits of action start to outweigh those risks. So there's an economic opportunity there. You can get credits more cheaply if you act now. And there starts to become the pendulum will swing back on expectations from stakeholders. So you're seeing this happen, and we see it in our interactions across the market. So this is a good story. So it's not all gloomy. So how do we fit in? I'm just going to whiz through this. So when you start thinking about carbon in a more professional manner, you start to have to do things differently. So how does Sylvera fit in? So we would say this. So we're building the data and the workflow tools to facilitate the movement of those trillions of dollars. And this week, when I've met people, they've said, well, Sylvera, oh yeah, you're a rating agency, aren't you? And I say, well, not really, not anymore. We always started with the ratings, or we'll continue to build ratings. But what we do now is we provide an end-to-end solution for the life cycle of carbon investment or procurement, and that would be for governments and for the private sector, and that will be for spot credits and for credits for projects that are in the pre-registry, pre-issuance projects. And then I think it's difficult for people to understand, what does that even mean? Like, what does end-to-end mean? And we still produce the ratings. That's a foundational thing for us. So, but the rating only really lets you do one thing, which is to do due diligence. It doesn't help you do any of the other steps, but all of these are necessary steps. So you need a strategy, especially in a world where you have a very dynamic policy environment, the investment environment, cost benefits changing very rapidly. You've got to have a strategy. And then in the past, where people would kind of maybe start with this 0.5, they'd just start to buy things, they'd be told that the due diligence had been done, but that, it's all a bit amateur. Once you have a strategy, then you can go out and source against that strategy. You can run a professional evaluation process, and you can think about price, the economic value, and you can think about assuring and monitoring those purchases and meeting a strategy. So this is something we've been helping with for our clients over the last year, aggregating all the news, providing the so what on all of the policy changes. So this is live in our platform as of this is just a snapshot as of yesterday night when I did the deck. We've been, for a few months now, publishing assessments of country risk. So when actors are writing very meaningful checks, it could be a private investment on a development, could be government, they need to assess the risks in those jurisdictions. They're very material, and you need to have a homogeneous way of assessing and managing those risks over time. So we have these reports, and we have a comparison tool that allows people to manage those risks, and these are maintained dynamically in a nice, stable, repeatable way over time. To find the best projects, you need to know which projects exist. So we aggregate, there's 12 registries at the moment, nearly 21,000 projects, daily updates on the availability of credits. So we've had very large businesses say, we're trying to build a multi-million ton a year portfolio. We can get them to an initial set of projects within minutes. And it's just very onerous to have to aggregate this data, so we've done it for everyone. That also includes projects that are not on the registries because they're CDR projects or they don't exist yet. So we aggregate, we have hundreds of projects that are effectively investment and development opportunities listed on our platform. As well as ratings, we do these very quick screenings that people can request as a user of the platform. These don't cost anything for the users. We've invested to cover not just nature-based, but technology, avoidance, and removal. We have 4,500 prices or price histories in the platform. We've seen, on average, our corporate buyers overpay about 40% versus what they could get credits for. So that can be millions of dollars of savings for some clients. Nobody has really understood what the price is, so we've aggregated price information from multiple providers. And for projects that are in the development phase, a rating isn't really good enough. As I mentioned, if you're going to make a long-term investment decision, you need to know that the quality of the credit is real, but you also need to know that the project is going to deliver the volume of credits that is in the spreadsheet that you've signed up to, and that almost never happens, right? So we try to identify the drivers of the under-delivery. We help the off-take or the investor build their contract out, so there's information rights, and then we can check those information, which is way over and above what the standard, voluntary standard will require. And also track all these external factors. You know, you could do all these things right, and you might lose your license to operate from the government or from the region you're operating in, and it would be a disaster. So this is about the investability of these projects. And if we can kind of summarize how we are seeing the most effective actors work, it's a very different way of thinking about it. And this is actually not just in the private sector. You're seeing our government clients think about things in this way also. So it's actually quite been, I come from a background in renewables, and the structure and focus on costs and risk in renewables sector is very, very strong. You haven't seen that in carbon to date. And you're seeing a best practice emerge that looks more like what you would expect in a mature, scalable industry. So there's some concept of a portfolio that you're trying to build. So this could be a corporate buying to retire. It could be a fund trying to hit an IRR goal. It could be a country that's trying to meet its obligations under the Paris Agreement. But there's some set of credits with characteristics that you're trying to build. To have the target portfolio, you need to have a clearly defined strategy. It's almost never the case that we would encounter somebody and this is true. Normally, we'll meet people, and I was with the government last week, and we were saying, so what's the goal for you? What is the strategy? And they were like, oh, that's a really good question. I was like, well, maybe now might be the time to write that down and get aligned on it, because if you start acting without this clarity, then it's just impossible that what you do will be optimal, right? It's just impossible. But to have a strategy, you need to understand what your constraints are, what your obligations are to external parties, what you might have communicated voluntarily, and you need to understand what the market conditions are. If your preferred strategy costs 10x one that's like maybe almost as good, maybe the almost as good one is okay, right? So these things require a different way of operating than most teams that we've seen in the market. To have these things, you basically need market information and policy information, and to manage a portfolio effectively, you need to track that in a system that scales. And you need all the data to be homogeneous. So this is the kind of the model that we'd see. Frankly, I don't think anybody kind of exemplifies this, but you do see this in different teams are kind of doing different parts of this like better. Now, how do you get to the portfolio? This is like jump to that. You would have a funnel. So the is kind of hidden here a little bit, but like typically you'd see a skinny funnel. So people looking at way too many projects and opportunities, and they should assess a large set. So that's the first thing we normally help with, is basically benchmarking, what's the ratio of things that you should look at to the number that you should act on. And that requires some scalable processes, which you're just starting to see emerge in some places. And the classic thing that we see is, especially in early movers, who kind of some of the brand names you might know of, the origination team sits in one part of the building, and then the portfolio management team sits in another team, and they don't use the same data, or they don't use the same KPIs. So the data that's been used to select projects isn't the data that's used to manage the portfolio, and negative consequences ensue from that. So we'd recommend, you're building your portfolio to a target, and you use the same data across the board, right? This is it all seems self-evident, pointed out like this, but again, you don't see this in general in the industry. So this this whole thing relies on clarity on strategy, as I said. And that's why we've chosen to start our first panel on strategy. So I'm going to hand over now to Adrienne, our COO, who's got an amazing panel who's going to talk strategy with everyone. Thank you.